Hello, it's Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for February 9th of 2025. Well, we do have a lot of ground to cover, so let's kind of hit the hot buttons here first of all. Obviously, trade policies in the news lately. The Trump administration announcing a bold set of tariffs against Mexico, Canada, and China. Now, at the very 11th hour, we had a 30-day reprieve on those that were set to impact Canada and Mexico. A lot of this has to do with pressure that Trump administration is trying to put on them to manage illegal border crossings, fentanyl, drug trafficking, so on and so forth. 30 days is not a long period of time when you talk about, government relationships and the back and forth and whatnot. So we'll just have to see how this plays out. Now, China, on the other hand, that is a tangible impact that we're going to be starting to monitor here because those tariffs did go into play. And China did retaliate to some degree with some tariffs that honestly, I think were designed to not escalate the situation further because they were on items that, are really not much of an impact to the U.S. Items like, say, coal, that we don't export a tremendous amount of coal to China. But you can see here very clearly the impact potentially to trade flows. And really, it's at this juncture, it's not the actual tariffs, it's the rhetoric surrounding it and the anxiety caused by it, because you're already beginning to hear firms that have international exposure that sell in products here in the U.S. but source the components to those products, or the interim stages of production are dependent on foreign trade. And so you're already beginning to hear that kind of dialogue right now, which is coming at an interesting point because we're kind of towards the tail end of the fourth quarter earnings season here, and we're going to start to begin to focus on first quarter. And I think you're going to hear a lot more about how people are trying to play defense with the potential of these tariffs. But clearly, Canada, China, Mexico, 43% of U.S. imports, very important. Rest of the world here, not to be discounted, but much smaller in stature. Next chart I have here for you is a history of tariffs. On the left-hand side, you can see, we've got to go back to the early 1800s. This I'll term as the latest or the most recent big bubble. And this was the Smoot-Hawley tariffs back that preceded and eventually helped to contribute to the Great Depression. So that was back in the late 20s. You can see here that has generally gone down since. And then we have the Trump tariffs, just for perspective's sake, did increase this line off of its base somewhat, but again, not to the magnitude that we saw back in the 20s and 30s. And then sliding over here to the right, we've got top 5 U.S. goods imported by value from these various regions that account for that 43%. You can see here, Mexico, not too surprisingly, vehicle parts and vehicles. You see cars, and to a lesser degree, electronics. Canada, of course, is crude oil, and to a lesser extent, cars and vehicle components and parts. And then also we have more commodities down here. So to say that, you have more consumer-facing goods that are impacted here in Mexico, a lot more natural resources and commodities here in Canada. And then we get down to China, then as you can certainly imagine, we have a lot of consumer devices. And so this is important in the sense that U.S. is a consumption-driven economy. And a lot of what we buy is made in China, or it's prefabricated in China. Just think Apple iPhones, most of which are sourced and then motherboards laid in China, and most of it's assembled in China. And you can see here toys, games, computers, electronics, and to a lesser degree, apparels and textiles, which I would argue, a lot of those industries have worked to move more production to the Philippines, to Vietnam, and to some of the areas that ironically have lower rates of growth in their labor costs. So more trade data here. This one really China. This is a kind of a breakdown of what those Chinese imports look like from a U.S. perspective. And you can see here from that last slide's worth of conversation, consumer and electronic products. Again, think iPhones and consumer electronics, and then electrical components. And then you slide over here and you get to metals, equipment, and then more, like leather, allied products. Again, much less impact here. And then you got the kind of this other bucket here that kind of represents everything else. But the big one, consumer electronics. I'm going to throw this chart in here just to highlight the importance of energy in the trade balance for North America. And of course, we had NAFTA, and then that was replaced by its most recent iteration. And a lot of this had to do with the consumer automotive products that we've already talked about, but a lot of it has to do with energy. And you can see that the U.S., there's a very robust trilateral trade in energy here. And so it's very important. From a refining standpoint, you look at the Gulf Coast there, where a lot of these refiners are, at least from the heavy crude that's coming out of Mexico. And so the quick comment here is that a lot of what we produce in West Texas and the shale, that's light sweet crude. But ironically, a lot of our refining capacity is geared to produce heavy crude. And the heavy crudes come from Canada, heavy crudes come from Mexico, and so we depend on that. So you can't just take any crude and run it through a refiner, because you're having to crack it and there's a chemical process involved. And if it's a different kind of crude, then you've got to go through a different kind of process, which we're not going to talk about here. But suffice it to say, it's important to have this energy ecosystem in place and not be disrupted by a tariff regime. And if there's a way for these countries to retaliate, this would certainly be it. And a lot of the heavy, sand-based crudes that come out of Canada are going to these Midwest refiners. And so when you think about the energy demand from this whole eastern seaboard, and because you have very dense population centers along the east coast here, and particularly in the Northeast, that's an impact if that crude is hard to come by. The other thing I'd mentioned about the energy trade here is the fact that we see OPEC's crude oil production on a barrel per day basis. You can see it continue to decline on a multi-year basis. And of course, OPEC, for many years, and this goes back to 2015, but if you go back a lot farther, OPEC clearly had a lot of influence, and the cartel itself had a lot of influence over pricing. Well, given the rapid production of the U.S. And some of these other non-OPEC regions, their influence has waned, and so their ability to control prices via productions and quotas and such has not been as impactful clearly lately as it has been in the past. You can see that the oil production is going down, so therein it becomes much more important for the ecosystem related to North America to continue to work from an energy perspective. I have a couple of charts here for perspective. This one I'm going to throw out there that this is kind of reflective in 2000. You can see a lot of blue on this page, and that represents higher share of trade with the U.S. versus Canada. Most of South America. You can see that a good chunk of Africa, although you had several countries within Africa and then the Middle East. Here's Iran that did business with China, that had a higher share of trade with China. Now let's look at the chart that brings us more current, and you can see that that has changed quite a bit. So China has been very aggressive, not only with some of these countries with their Belt and Road Initiative, but they've been very aggressive from expanding their capacity and obviously taking advantage of their accession to the World Trade Organization, WTO, some 20 plus years ago. And you can see the calculus has really changed. And oddly enough, we talk about Canada and Mexico, and these are really the strong bastions of trading that the U.S. enjoys. And obviously, we talked about the 43% of imports that are accounted for by these two countries and China. So these two countries are extremely important, but you can see the influence of China around the globe in really just 20 years. Here we have a trade balance with major partners. We talk about this a lot, and we have this is a point in time, look at the 12 months through the end of November. And you can see that if we look at 2016 versus 2024, dependency on China has gone down. And this is a U.S. trade balance with major partners, where you can see the trade deficit, if you will, with the European zone has actually increased, as it has with Mexico and with Canada. And you can see Mexico is very important. If you bundle these two together, you can see that there's a huge magnitude of change, as well as the euro area. But again, these are much more impactful trading partners to us. So we'll continue along the trade theme here. This is more of kind of a trend line look and just kind of give you perspective. Here we've got annual trade balance. Our trade deficits have only expanded. Again, we're a consumer-led, consumption-led economy, and so we have had increased liquidity by virtue of the pandemic checks, and we've had a lot of easy money coming out of the Federal Reserve. We know that lots of liquidity leads to lots of consumption, and that demand for overseas production has only increased. And you can see that we're clearly importing a lot more than we are actually exporting, and that's why these numbers are increasingly red here. So as it relates to the key trading partners, you can see, as we talked about Canada, that number continues to expand greatly, and as we saw on the last slide, so does that number with Mexico. And and then we had this kind of peak here in the latter part of the last decade, and so when the Trump tariffs were enacted, we saw kind of a paradigm shift here in the trade balance with China. Now, granted, it's still very significant in aggregate terms, and we're still talking over $300 billion, where Canada, these numbers, and even with Mexico, are a lot less. But so China still matters, but from a directional point of view, clearly has changed. And so when we look here too, that we've got the U.S. trade balance of goods and services, this is just reflective of how the trade balance has really exacerbated. Again, this is something that clearly gets the attention of the new administration here. And this is a fairly dramatic move. And this is trade balance ex-petroleum, and that has had a similar move. So, I mean, our trade imbalances are very acute and have become more so with our key trading partners. So, tying this back to the market, this is important because why? Well, because when we look at the exposure to the S&P 500, again, S&P 500 is just one index, right? But it does represent a fairly broad swath of the U.S. economy from an industry standpoint and obviously from a market share standpoint. But you can see here that this line, I call it line of best fit going back to 2002, is probably somewhere about like here. And so that is just about 40% on a trend line basis, and it was actually 41% in the latest year. But to say that basically, somewhere between a third and a half of all S&P 500 revenues come from abroad. And so when you think about the risk of tariffs, this is something that you have to take into consideration because those costs could be going up at a time where you're not getting support from the dollar, which has been extraordinarily strong here as of late. So a strong dollar, may obviously that it implies a weaker opposite currency there. And so, if you have revenues in that country and a strong dollar, then you're basically translating, less revenue over because of the strong dollar. And so, again, we'll have to see how tariffs impact this component of the S&P 500 return to the degree that it will impact over the next several months. Okay, pivot here a little bit. We're going to talk about break-even rates, and this is kind of like the inflation proxy. So this is a 2-year Treasury break-even rate. So this is basically the yield difference between what you would get in a 2-year U.S. Treasury bond and what you'd get in a 2-year inflation-protected bond. And so that number right now is 3%. So what does this tell us? That the inflation expectations on a near-term basis have migrated up to about 3%, and they were stable about 2.5 for several months, and now they picked up, and really the reason is because of this anxiety over tariffs. We're going to talk about some things that get my attention. Productivity is something we talk about a lot because it does help to keep inflation low. Good news here is we got U.S. labor productivity that was very much in line with the estimate for 4Q. And you can see, not drawing too much of a, trend line analysis, even though it may look like it's down, like factor productivity is in decline, but it's still positive, and it's been positive. It's been resolutely positive for the better part of 2 years now, and again, it was in line. And if you look at productivity consecutive quarterly gains, you can see going back to 1996. Obviously, you had the pre-tech bubble. Here you had the post global financial crisis peak there, and then you've got a period in that last decade where we also saw these prolonged periods of factor productivity. In fact, that long period of factor productivity has put us well above that trend line that we saw before the pandemic. So, from a factor productivity standpoint, we're really getting a lot of support here, and it is actually helping to not only keep a lid on inflation, but to help to bring it down over time. Well, we can't have a chart of the week pack here without talking about AI in some form or fashion. So, like I said earlier, we've had a lot of earnings calls for the fourth quarter, and this is a chart that measures the number of mentions, and you can see the proportion of S&P 500 firms that are mentioning artificial intelligence during their earnings calls, and obviously that number continues to go up. And half of the firms that have reported, that have had conference calls with analysts and investors, have been talking actively about AI. So this is just one proxy of how we're going to see AI be implemented down the road. If firms talk about it, and then they commit to projects that involve the implementation of it. And then after that, the third phase is when you actually begin to see the productivity that's generated by the implementation. So we're still kind of phase one-ish right now, but as we look into probably 2026 and certainly 27, we'll begin to see more AI initiatives be designed and implemented. We have manufacturing PMI. We've talked a lot about that. We've had this prolonged manufacturing recession. A couple months ago, we began to start to see some green shoots, and now that we've actually seen that turn positive. So just to remind you, the Institute for Supply Management Manufacturing Purchasing Managers Index, that's what PMI stands for. And this is a diffusion index on both the overall index as well as new orders over here, which also turn positive. So everything above the dotted lines here represents expansion. Everything below represents contraction. So just as we saw with the overall index and basically manufacturing in general, it was weak for a couple of years. It was also weak from an order standpoint for quite a while, and now it's turned positive. So Good news here from a manufacturing perspective. So here's a regional Fed, kind of a composite of regional Fed surveys. And so, as you know, we have 12 Federal Reserve districts. They each have kind of their own regional survey. And so you put them together in a composite. What does that tell you? That this manufacturing survey is turning up. And you can see a very strong relationship here between that index that we were just looking at, that ISM PMI composite manufacturing index, and this Fed survey. And so this is a case in terms of a survey, which is what they call kind of soft data, which is getting a sense from managers on what they're going to do. And oftentimes, the proof is always in the pudding. So they tell you they're going to do one thing, but you have to back it up by what they actually do. And in this particular data series, going back to 2004 here, it is largely accurate. So what is said in the survey generally plays out here over time. And so what this tells us now that we're getting these really positive surveys in manufacturing is that the ISM should continue to follow. And even though we've, and this may be lagging ever so slightly, but that we should begin to see some more meaningful positive trends out of manufacturing overall. Here we have construction spending was better than estimated here, better than expected. We've had a couple of months of increased construction spending. What's really interesting here, and this on the right-hand side, you can see private construction. You've got non-residential here, which has been flatlining. A lot of this has to do with kind of office being out of vogue and this whole work from home thing. But as we look into the second half of the year and certainly into 2026, it'll be very interesting to watch this non-residential private construction line, because we are seeing a rash of announcements by large firms, and even here locally, Dell Computer has ordered people back in the office 5 days a week. And you're seeing that more and more. And so, while we've been sitting here looking at office absorption as taking like several years, well, that timeline might accelerate somewhat with some of this general trend of, work from home is kind of going away to some extent, and more people are going into the office. This line represents residential. We've had some real fits and starts, but still a very strong need for housing stock in a lot of major markets. So this number continues to move up, but like I said before, this is kind of flattening out, but I expect it to go back up once we, and to the degree that these come back to the office things kind of hold and begin to take root. Here we have corporate sentiment. This is from B of A Global Research. Move higher. So you've got S&P 500, companies that are feeling better about things, even though this is a kind of a composite score, and so it's basically becoming less negative. So I'd say that we're trending to a better spot when it comes to overall sentiment. Which, if you talk about sentiment, you have to talk about capital spending, because if people are not positive in their outlook, they're not going to be spending. Now, we do know that there are, even though this chart, and this is very busy because it's got several of the regional Federal Reserve districts kind of reporting their own districts' constituent spending plans, capital spending plans, and all these things are moving up. Now, we've heard lately, again, with the tariff regime kind of like uncertain at this point, we've heard from some companies, major companies that probably speak for a wide swath of companies that might otherwise be represented in these surveys, say that they're going to kind of hold off a little bit. They're going to still budget for this, but they're going to hold off on actually spending it until they see where the tariffs go. But overall sentiment is leading into capital spending plan expansions, which is very good for the economy. It's good for manufacturing, and ultimately it will be good for services as well if it plays out. Here we have job openings. Labor market continues to kind of attenuate somewhat, and that was all by design. So labor market kind of settling in. Maybe a little noisy here in this last data point, but U.S. job openings have come down. Again, we've expected it. We've been watching it play out for a number of years now. Very kind of a normal trajectory after the amazing dislocation that we had due to the pandemic. Here we have same store retail sales, so the health of the consumer and overall consumption, which is 2/3 to 70% of the overall economy. We've been talking about how we are a consumption-led economy. Well, that consumption is actually running pretty strong right now. I mean, basically, we look at over the last year, and it's been about as steady an indicator as we have in the economic basket here. Now we'll take a look at the Institute for Supply Management Services PMI. And we looked at manufacturing before. Services has been relatively strong for quite a while. Whereas we saw in the manufacturing version of this, that those numbers were negative for a couple of years, and we kind of had that rolling recession in manufacturing. Services have been strong, even though they are coming off their peak. We do see that clearly in new orders as well. But again, nothing to panic about now. Again, we've got manufacturing that's on the rise, services that are still relatively strong. And I'd tell you that anything kind of in the 50 to 55 range is healthy, and I've often said that, you get into 60 for a prolonged period of time like we were in before and at various points after the pandemic. It's hard to sustain that level. Here we have a different look. And so this maps the Institute for Supply Management, the ISM services, like basically this number right here. It maps it against the global backdrop. And what we see here very clearly is that there is a positive relationship, and that we see the global trends mimic what's going on here in the U.S. Now we'll talk about the S&P 500 and kind of get into valuation a little bit and volatility a little bit. Here we have on the left-hand side, we've got basically a trend line of the S&P 500. So what this highlights, even go back to 2008, we had the COVID sell-off here, and then we had kind of that, the inflation and rate hike issue that brought us below these trend lines. So this is kind of basically a trend growth of 12.5% annualized, and then you've got a range of 12% on either side of that. And we're right in the middle of that channel right now. So, in many respects, you've got a part of the market that is very overvalued, which is reflected here in this next 12-month PE ratio, and you can clearly see growth, is relative to its 10-year average, and basically to the beginning of this month, very, very overvalued, expensive relative to the last 10 years. But despite that, you've got all of these things that are really kind of close to that, that trend line here. And so what that means is the overall market is, when you look at it, from a full constituent standpoint, is really trading in that channel, although it feels like it's moving at an accelerated pace. But again, just to put things into perspective, this shows us that we're definitely trading kind of within that channel. And over here, just to kind of put a bow on this, growth, of course, is represented by the Magnificent Seven, the technology high flying stocks. You've got growth that is that is expensive relative to the last 10 years, and even the overall index expensive to the last 10 years. Here's momentum. Here's low volatility that is called a little bit of a bib. These are dividend aristocrats, equal weight, and the ones that fall below the line are basically the S&P 400, which is the mid cap index, and the S&P 600, which is the small cap index. And so, but you clearly see more opportunity here in low vol, in dividend growth and value than you do in the growth sector at the moment. Here we have some more information on valuation. We've got historical valuation percentiles and where they stood at the end of the year. And you can see here's different measures. Here's price to earnings. Here's average price to earnings. Here's price to book, free cash flow yield, and enterprise value to EBITDA. I won't bore you with the kind of the technical definitions here. Then you have small caps, and you have global stocks outside of the U.S. At least on the equity side, you can see, we're in the higher percentiles in just about every category, except oddly enough, international, which we have talked about, relatively cheap. And then average, that would be, basically the equal weighted index. Again, not terribly expensive relative to some of these other categories. And if you look at credit, we also know that credit is expensive. And you can see, we'll see this a little bit later too, that investment grade bond spreads are very, very tight. Again, the market not in any way expecting a credit problem. And so, we're seeing those spreads real tight and valuations at a real premium. And this is high yield. The spreads are also really tight here. And then this is leveraged loan, LL. Again, all of these credit-related bond categories are trading very expensive at the moment. So this is something I wanted to take a look at. And again, just for perspective's sake, because forecasts can often be wrong. So here we had forecast real GDP growth in 2023, right? A lot of people thought we're going to have recession. Well, they were completely and utterly wrong. 23, in fact, was a relatively good year for growth. We were almost 3%. We followed that up with an average forecast of about 1.4% in 24. Everyone thought, well, okay, we're going to have less growth. Well, they were right, but they were very wrong in the sense of the magnitude. In fact, they undershot it by like 50%. And so this year, consensus now looking for roughly 2% here on economic growth, and we'll have to see where things play out. But this just shows you that analyst forecasts might be fun to read at the beginning of the year, but oftentimes they're just completely off the mark. And before we leave this slide, I'll just highlight the fact that S&P 500 earnings growth predictions can be a little volatile too. 23, again, expecting a little bit of a recession, did not get a recession, and you actually had positive S&P 500 earnings growth as opposed to the negative forecast that had preceded or that had existed when we entered that year. Well, 24, the estimates were pretty much spot on. So, not altogether unexpected, but they were about 8%. And so now the estimate that we all talk about now is that, oh, well, we're talking about like 12%. Well, 2 months ago, this estimate was like 15%. And so estimates have been tempered. And as we entered the year, everyone thought, and myself included, I'm a little bit of a skeptic. I think we're going to see maybe something that falls into this category, which would obviously be very good. But it just highlights that you can have expectations that are off the mark over a 12-month period. Here we have earnings forecasts, and as I mentioned here on that last slide, that we've had those estimates that have been coming down, which I think is a really good and healthy thing. I'd be very concerned if we started to see these estimates move higher again. Again, we have a new administration. For a while, we were expecting maybe a slightly looser regulatory environment, that maybe a slightly more pro-business environment. But I think if anything has been proven is that the new administration is like a bull in the china shop with regard to policy changes. And so I think that kind of uncertainty has led analysts to kind of loosen up on their estimates a little bit. Again, I think that's a good thing. So Concentration is high. We talked about last week. We've had two very significant years in terms of the concentration of performance in the index. We've had very narrow leadership each of the last 2 years, and then this is kind of highlights that. And again, you can see that the genesis of this started before the pandemic even happened, but it just accelerated after that. And so great work by Rich Bernstein and his team is that when you have a broadening out of the market, which we are beginning to see, actually, even though this kind of belies that, but we are beginning to see the broadening out of a market, that usually harbors increased volatility, which we've all been expecting. Here we have kind of a chart, and it plots basically forward price to earnings ratio, so forward multiples. Obviously, these are extremely high multiples, very expensive, and then that's plotted against forecast earnings growth. Again, as we just learned, or as we just discussed, these forecasts may not prove to be accurate, but at least where we are in terms of entering the year. Now, obviously, you definitely want to be you want to be down here, essentially. Now, this is really cheap down here because but you're not getting a lot of growth, and so we see that at the Eurozone. Although you're likely going to get more growth out of the Eurozone this year than we did last year. China, we know, is in a bit of a funk, and this number could be anywhere on this chart because we do feel like the earnings growth in China is going to be challenged this year, but at the same time, stocks in this area are cheap. So Japan stocks not getting growth, but they're relatively cheap. UK, the same thing. So basically, Europe and Asia stocks are really attractive from a multiple standpoint, but you're not really getting a lot of growth. And so this is why this is termed kind of a value trap, because you may be stuck in this area for a while trying to kind of wait for your value proposition to be realized. And then you get over here, you've got emerging markets, that's EM. So you're getting really strong growth and you're getting a relatively cheap multiple, like 12 times. And so this is an area of focus for us because the numbers do work out here. Now where you necessarily don't want to be is stuck up here. And fortunately, none of the areas that we track are in this area. But if you transition over here, you've got some of your major indices. You've got the S&P 500, Russell 2000, Mag 7, and NASDAQ that are all trading with reasonable earnings growth. And we talked about, even though the estimates are coming down for the S&P 500, they're still almost, I'd say probably more like 12% right now, but they're trading at higher valuations, and so this is why we just want to be a little careful and balance our portfolio out with some exposure into these areas that provide maybe a little bit more value. Here we have a chart that kind of plots stock bond correlations with treasury yields. And what's really interesting here is when we see treasury yields move higher, and that's in the black line. When we see treasury yields move higher, the correlation between stocks and bonds increases. And what's the significance of that? Well, we run diversified portfolios where ideally, we use the bond allocations to offset the volatility of the stock market. Well, when correlations increase, and in this case, we're at kind of 0.5, 0.6, which is not fully correlated, but they're definitely positively correlated. I mean, you want, the benefits of diversification come into play when your correlations are low. So I found this chart particularly revealing in the sense that when you have interest rates that are low, you tend to have less correlation, but when they go up, that correlation really increases and probably dilutes the value of that stock bond correlation somewhat. So what it does is it begs us to think differently about how to fill those stock and bond buckets. And that's why we use structured investments. That's why we're looking at that completely differently, in large part because of the phenomenon that's exhibited in this chart. So here we have earnings yield, implied volatility. You can see here that this is implied volatility down on the bottom. This is 90 days. And then this is the forward earnings yield. And so, income is a huge component to overall return. And, I'd say that earnings yield is a really good proxy for dividend yield, although it's not perfect. But obviously you want to get as much earnings yield for the dollar of investment as you can. And so where you're getting basically higher earnings or reasonable earnings and relatively low volatility is in value. It's in dividend growth. It's in revenue, strong revenue companies, companies that are strong in their industry, low volatility. You can see the S&P 500 right here has a reasonable earnings yield, and as we know, it has not had like really high volatility. But if you get into, mid caps and you get into growth like the Mag 7, you get momentum, then you get really high volatility, and this is what we're trying to avoid as portfolio managers. And then when you look in the international sphere, the U.S. actually plays really well, and so this is the risk. I mean, you get high earnings yield, from emerging markets, ex-China, and some of these other areas, but you're taking on more volatility, and we certainly don't. We want to try to minimize the stock volatility as we can and be choosy where we're getting good earnings yield, but we're not having to take on a lot of risk. And you can see that some of these areas here, Asia Pacific, that's Japan right there, present some interesting opportunities for us. Here we have venture capital. Just a quick comment here. I mean, I know private equity, and venture capital. I mean, this is more earlier stage, but you see the number of unicorns, which is companies that have valuations over $1 billion. You can see that is in decline, and oddly enough, that is correlated, at least right now, with a higher Fed funds rate. Although this is not a perfect overlay, but it's just kind of an interesting point in time. Kind of makes me feel like Christmas a little bit with red and green here. But bottom line is really this red line that shows you that we have not had a really strong environment for venture cap and necessarily for exits on the private equity side. But the 2025 is expected to be a much, much better year for both of those categories. Another thing that's really interesting too, that's worth paying attention to, is like, go back to 1980, the average number of years that companies would have to wait before they went before they went public. They had an initial public offering, IPO. That number was 6 to 8%, or 6 to 8 years rather. They kind of stayed constant, and then you had the tech bubble, and a lot of companies were going public before they even had a viable business plan, for heaven's sake, and then that obviously reversed. But then that set the bar higher, and what we've seen here is yet another leg up. And so, instead of like the 1980s and 90s where it was like under 10 years, you were generally going to go public. Well, now it's like more like 14. And it comes at an interesting time because we have a lower supply of equities. I mean, a lower number of issues that are publicly traded now, at the same time that we've got more private companies that are taking longer to go public. And so it's going to constrict the number of available investment opportunities here over the next 5 to 10 years. This is just a chart showing you how robust the kind of the credit markets are in fixed income. So, this is leveraged loan issuance. I mean, just gone absolutely through the roof here. Really strong issuance. We saw the chart a few charts ago credit spreads are tight, valuations are at a premium. You could see year-to-date leveraged loan issuance is super, super strong. I mean, relative to a year ago, and 2024 was a strong year. This is blowing that out of the water. And what are companies using proceeds for? Well, they're actually doing a lot of repricing. So they're taking existing debt and just and they're repricing it. They're also refinancing that debt, and then there's always new money in there. But just as we saw with the spreads and those other charts, that spreads at issue are really low. I mean, this is an environment that, if you look at it, you say there's no fear of a credit problem here. There's no fear of a major economic downturn here. This is what very tight credit environments tell you. So the last chart on here is something that caught my interest very, very much. There's Torsten Slok of Apollo. It's a private capital, private equity firm, is a well-renowned economist, and he has a daily chart that I just love to read, and every day is insightful. This one in particular, that every single day, you've got 32,000 people in China that are turning 65. Again, the one-child policy, China's population is in decline, and you've got a lot of people that are becoming old, and they're going to have to be taken care of. And is this whole shift now to aging societies? Well, U.S. About 11,500 per day. We are no spring chicken. We've got an aging economy too, and that comes with all sorts of implications. Japan, we know, is has that age problem, and so does Europe, frankly. But you can see how just outsized that issue is in China, where you're going to have a problem because you're not going to be able to replace the people that can't work anymore with people rising up, because that birth rate is not anywhere close to where it needs to be. That's all we have in the chart pack this week. I know it's a little bit meaty, but we'll not have a chart pack next week. So we'll be back in 2 weeks with more data, more charts, more information for you. Hope you have a great week, and we'll talk to you again soon. Take care.